Trump 2.0 melt up or cycle peak. Clearly, it's thematic and timely given that we're 1 week away from inauguration. So I'll cut to the chase and fast forward to the key insights. We kick off with Trump 2.0, a two-stage pattern based on buy the rumor that has passed into the election result and fade the fact 1 week from now, which is already in play, but the unwind may continue. Time will tell. The market seems to be mixed at the moment, so we'll be watching day by day, week by week. A few related points to that, and then the second section, S&P 500 bull trap reversal. What are the important points in terms of trend pattern, momentum, but also timing? I've included a brief mention on the Decennial pattern just because it's been so topical, and it's been a hot debate amongst us FSC peers, but also many of you community members. And then right at the end, probably my grand finale close will be the cycle convergence, which is based on cycles that we all track in different ways with different variation views, but in recent research and also interviews with cycle practitioners, the consensus seems to be a super cycle alert for 2025 this year over the next few years. Certainly you would have heard a few people already mention that. Andy Pancholi talks about 2030 as a big cycle inflection point, and areas into that. And of course, you would have heard other versions too. I'll go into that point as well as others. Okay, so Trump 2.0 election playbook, according to my work, has been buy the rumor, fade the fact. It's based on the election fever climax amidst Trump's victory, which is now past headline news, but the market did get euphoric from it. Risk sentiment fueled by a mix of revived animal spirits, fiscal policy impact, and crypto-friendly deregulation. Crypto, Bitcoin did pop above 100K, although it's unwinding now. The big question, what next? So this pattern, think of it as a seasonality pattern. Bill was just talking about his interpretation of the presidential election pattern, which is always interesting. It's typically flat to weak, but if you look at the short-term zoomed-in version, you get the extended upsurge from already a strong runaway market into November election result, particularly if it's in line with a predicted and preferred result, which was the case for both Trump and the Republican Party, which led to the red sweep. But what that typically follows with is a double whammy headwind. One, profit taking from very strong trends where people have made money and do want to lock it in. But two, policy stress tests within the first 100 days. That's a political term, but it also tests out in the data, particularly when there is big change, which likely leads to uncertainty with polarized expectations, then that typically leads to volatility within the first 100 days of a new president-elect. So this brings up the theme of sudden change, and it's a behavioral insight shared by one of my original mentors, Mr. David Fuller, who worked with Alan Shaw. You heard Bill Cerulli speak about Alan Shaw at Smith Barney way back when in the 70s, an industry peer to others of the time. And the key insight there is sudden dramatic change is never anticipated by conventional wisdom. It's especially true with our impactful memories of a range of disruptive type shocks. I've highlighted a few notable ones: pandemic 2020, generationally high inflation 2022, heightened geopolitical risk throughout 2022 in terms of Russia, Ukraine, but then of course Middle East last year, and Asia here and there. Certainly we had Korea kick off in recent times, and talk about other event risks too. And of course, during this entire time, we've had legacy recessionary fears as well, proven wrong initially, and time will tell whether it does actually occur. Either way, the the precarious zeitgeist of last year and years before proved in the end to be overcome as a wall of worry where the bull market just continued higher and higher. And we hit greed extremes and fear sentiment stayed at record lows. So that's where we still are, but that does provide an inflection point to reflect on. So here's the evidence behind the data: record investment positioning, looking at momentum and liquidity. The quick measure I'll give you is NASDAQ doubling in value in the last 2 years. Also back-to-back 20% performance on the S&P 500. And the last statistic, which I find even more interesting, is if you felt tired being a bull, it's because we had 54 all-time highs on the S&P 500 last year alone. Now, that is a bullish outcome, and that is a strong trend. Follow the trend, don't fight it. But there is a dilution effect. There's an exhaustion impact, but there's also a dilution effect when we have these types of extreme statistics. And on the positioning side, both retail and institutional were proving at record levels. However, beneath the surface, multiple blended indicators that I use and others too have become rapidly less supportive. Asymmetric risk remains even greater. Again, we have to look at the price chart to confirm, especially in a strong bull market with strong liquidity. But keep in mind, we have seen a lot of momentum chasing, risk on rotation with hotter fund flows. And what that typically leads to is to fast moves in the opposite direction. And so here the question is, could we be in that paradoxical contrarian setup for a greater fool theory? Not something you can trade, but certainly something you and I can be prepared for and should be developing scenarios of just in case the risk side were to blow out. So one of the things I started doing years ago is to start throwing the ideas on a table in front of the trading screen and mapping out both positive and negative tail risks, the so-called white swans and black swans. So here's one I came up for 2025 based on my own views, but also lots of different investment banking research that I've been reading. And you can see the positive is Trump 2.0 reflation without the side effects. So that would be pro-economy, revival of animal spirits, and expansion effect. Positive reflation or tariff impact without, again, the side effect that comes with that, and a consequential melt up. These are all the positives that we could experience in that upside surprise scenario. On the negative side, we have had plenty of geopolitical risk, but it hasn't yet been systematic or market impactful. We have the makings of a policy mistake from the Central Bank of the US. They cut one last time 25 basis points, and the rate market jumped 100 points up and is nearing the 5% historical pain threshold. So that in itself is a potential demotion or a lack of vote of confidence from the market, and a potential bond vigilante event risk to come. You heard the view there from Bill of a potential inflation resurgence. I think a few of our FSC team members also share that perspective. I do too, and certainly the individuals I interviewed on FSC Cycle TV are concerned for that too. And ultimately, that could, each of those points lead to a risk unwind, and markets being sober-bought in momentum and positioning terms could also just lead to that turn. What all of this means is that defense is the best strategy, but you don't have to go to one side of the portfolio extreme. You can apply a barbell strategy whereby that allows holding selective risk strategies. Key point there is selective, and really kind of focusing sniper type selection of those trades that may be profitable. You just heard there tech may be negative, but there are other tech stocks that may outperform, as just shared by our previous speaker. So that's an example of selectivity. and stock picking, and ultimately active management. But ultimately, we do need to lock in profits where possible and build some downside hedging. This is the key takeaway from this particular insight. Now, I do want to highlight the concern. There is clear and present reasoning for it. And I want to focus your attention to the chart on the left. And this is something you can do on a yearly basis and just see what the probability distribution curve is for market return. I've done this for market return on various markets, but also on Wall Street's consensus views for market performance for the year ahead. And interestingly, they do match up. What it does show is that we are in abnormal positive performance territory. NASDAQ did double in value, and we did have back-to-back 20% returns on the S&P 500. But if you actually want to see that in terms of probabilistic measures, we are close to the peak of a distribution. You can see there 2024 is just there. 2020 is the peak. But I do want to point your attention to the left tails where we had 2022 shock to inflation rates and the geopolitical event risk. And then that was a 20% drop in the index, but 40% drop on tech. There could be an echo risk of that happening again. And then the tail risk, wider, fatter tail risk that many of you will have back of the mind, 2008, 2000. These are the big bear cliff drops of at least 40 to 50%. So that just gives you a statistical reference point. But what this does tell you is why the chart on the right matters now more than ever. This is why typically fear beats greed in volatile cycles. If you want to make money in markets and you want to have this type of market performance on your portfolio, the top blue line that is shooting up like a straight line, the primary objective needs to be risk management. Now, what does the data show? This is what happens when you miss the worst 10 days. You can backtest worst 5 days or use whatever metrics you want. You're going to get similar results. And if you exclude the best 10 days, i.e. the FOMO effect, you're still making money, but significantly less. So it's the relative underperformance of X best days versus X 10 worst days. Buy and hold is somewhere in the middle. That works when markets are behaving in a rational, strong trend, low volatility manner. But as we all know, that doesn't last forever. And that's why we need a mix of the two. Active management, where we can look for the best performers and the market timing opportunities, as well as risk management. Now, the big issue here is, from switching from FOMO to FOLO, is that our brains are wired in a specific way, according to the work of behavioral expert Daniel Kahneman. And ultimately, we tend to focus on one side of the risk-reward profile for survival reasons, but also for behavioral conditioning. Ultimately, while we don't control that or the changing seasons in the market, we can at least choose to adapt. And that is my call out to everyone. Whatever your view is in the market, do prepare for a change in trend as and when that does happen. Okay, so let's cut to the chase in terms of markets here and now. Have a look at the global model rotation, which is a systematic kind of trend, best and worst measure I look at over time, global cross asset. And we can see here a tale of two stories that remains. So Trump 2.0 risk trade shakeout from the upsurge that we saw late last year, Bitcoin overbought and unwinding sub 100. It still looks like it's in a sideways to topish pattern. S&P 500 potential bull trap reversal, according to my work. However, we do need to confirm a make or break level, which I'll highlight, a pre-election price gap. And then the dollar, which only recently looks corrective after a strong upsurge, And in future sessions, I can feature more on that. Now, the second part of the story is inflation proxy, and this is probably what we're mostly being blindsided by, because we're focusing on strong market returns in risk and in equities as a case in point, as well as the Trump 2.0 effect. But that's not a one-sided story. The other side is inflation resurgence. US 10-year yields did jump 100 basis points just after the FOMC rate cut, which is paradoxical and typical of a loss of confidence in the market, as well as structural inflationary forces. That was also apparent on break-even spreads in terms of inflation expectations, and that translated into the commodity market in terms of oil, which has a short-term pup to the upside, as well as copper on a relative basis. And then, of course, gold has been the outperformer of most asset classes last year, 40% from low to high, outperforming by equities by 10%. And so it's having a healthy unwind within a volatile range and likely to break to new highs. What you're looking here on the table, just to be provide the educational framing, it's long-term, medium-term, short-term trends from left to right, so trend performance over time. And then you have a quintile system, strong versus weak, best and worst. And you can see that Bitcoin at the top, rates going up in pink, and US equity market in blue, fall from grace. In absolute terms, it was holding up, but relative terms, it's becoming weaker. Okay, S&P 500 bull trap, question mark, because this has been a work in progress. The key markers that I'm continuing to watch are trend pattern reversal, momentum exhaustion, bearish momentum, bearish timing confluence. I did have a focus also on rotation in terms of sector leadership. I kept it out for now just because that's been mostly mixed, and it's the same story that we know, tech concentration with late cycle leadership, which may or may not prove out. For now, I'm just focusing on these 3 points, which should give us enough ideas for what may follow. Trend pattern reversal. This is the updated chart showing an impulsive trend reversal still in play with a corrective volatile regime. For those of you Elliott wave pattern watchers, this could be a wave 3 top. We can argue to what magnitude, but still it's a trend reversal inflection point, which did break through the pattern support and key levels. But of course, we are now in a potential recovery upswing, which hasn't achieved a new high breakout above 6,000, which would be key. And it did find support at the election price gap between 58.60 and 5700. That remains a make or break zone. And it's very much related to the confidence in the market for Trump 2.0. If we hold, then Trump 2.0 actually has a near-term positive impact. If not, then it's just showing that the market is unwinding from overbought conditions and potentially waiting for that 100-day stress test of Trump 2.0 policy impact. The other point here is that there are short-term timing factors. As you can see, the symbols on top of the chart, and I've only highlighted the ones in recent times which have correctly timed the inflection points to the downside, so the tops in this corrective wave. The next one is coming up into inauguration week, so there's additional timing pressure for that. And then for those of you that look at trend measures like moving averages, the 20 and the 50 short-term, medium-term are exhibiting a bearish cross, but the short-term price action remains mixed. So we do need price to confirm to the downside, new low breakdown beneath the previous swing low, but also beneath the selection price gap 58.60, 5700 to confirm the bear trend reversal, but also that trend signal, that bearish cross. Okay, and then of course, look at the indicator, you see the bearish divergence, which led us down, but now we have an early stage bullish divergence in the opposite direction. So that line in the sand is going to be the decider as to whether we recover strongly or fail and reverse down. I'm just going to quickly check the chat, see if there's any questions on this chart as I fast track through. If you have any questions on this chart, let me know. I do share these key market insights with the Foundation Market Working Group, which is a bi-monthly premium gathering of like-minded cycles practitioners. So, there are many questions that get asked there and also ideas that get shared. So if you have any questions, whether you're part of that group or part of the community attending, just let me know on the chat. Now, the other part of this is the momentum exhaustion. This was clear early on, but we had a high probability reversal signal on one particular indicator subset I look at, which is developed by Tom DeMark, and that was across multiple timeframes, monthly, weekly, and daily, and it finally proved out in recent times. So this signal is done, it's already confirmed, but I highlight it as an after the fact print, but also as a question as to should there be more of a shakeout or not. Is this the extent of the move and we just continue higher, or is there further downside ahead? Now I'm just highlighting there the election gap as a further confirmation of the exhaustion signal, and to highlight that if this signal were to way further lower, it is part of a bigger bull trap signal. What do I mean by that? S&P 500 bull trap scenario 2007 and 8 is the analog I've been following for most of last year, 2024. I did originally look at other analogs, including 2000 Y2K bubble burst and crash, as well as the 1970s and other analogs too. This seems the best fit in terms of a historical rhyme, not a repetition, but a rhyme, which is often how these patterns play out, because we had an all-time high, which was a head fake signal. In 2000, we had more of a melt-up stage, kind of a inverse of V-top, whereas 2008, it was a marginal high and then a three-stage corrective pattern. That typically plays out as a fall, rally, and rest of fall. And now the mid part of that, the rally phase is the head fake, which leads to the rest of the fall. And interestingly, that followed two event risks of that time, which echoed just recently the Fed pivot of 2007, as well as the election for that period too. So there's an eerie price analog, macro analog, and even time analog. Look at the corrective period. It was from 1 year to the next, 2007 to 2008. It was only in the first half of 2008 that we started to make a new low breakdown beneath a structural key level. The equivalent of that would be 5,700 and 5,600. The election pattern levels I mentioned, as well as the lower 50% retracement levels that I've also included. And ultimately, if that were to break, as it did then we would get a similar result, a rest of the fall ahead. Now, what makes this really important is the bull trap scenario risk from a behavioral perspective is based on excessive sentiment, leverage positioning, forced, not chosen, but forced to reverse amidst elevated volatility. So this is what makes this such a fast, dramatic downside surprise, which are harder to react to, and of course adapt in terms of the market and mind strategy. So again, to be if this were to happen or not, it's good to develop scenarios just in case and to be prepared. Bearish time and confluence, we're just going to fast track to the cycles, and I've added a little bit on bigger cycles, including the master cycle that the FSC uses as originally developed or popularized, I should say, by our founder, Edward Dewey, the 41-month cycle. And I've included something on the decennial too. But before we get there, election pattern and FSC model first on the short-term basis. So this is just a recap of the election pattern playbook based upon my analysis. Short-term by the rumor fade the fact, that's the short-term pattern. But the longer-term pattern I've included here based on data from Fidelity. You can see the subsequent year one of a new presidential election leader is flat to down, whereas the short-term pattern is also the same thing, but just on a more zoomed-in time frame. Now, the double whammy of factors are typically profit-taking, especially when we're at extremes in terms of momentum and positioning, as well as the first 100-day policy stress test, particularly when it's amidst polarizing expectations. Yes, the market is bullish, and yes, we're even pricing in a peace dividend in terms of potential stability in Europe and the Middle East, but there are potential event risks still ahead. Time will tell. Certainly, inflation is one. Markets in general, as well as potential additional event risks that we have yet to discover. FSC timing model has been bearish in the short term, but there were different variations of that bearish pattern, one suggesting a year-end rally, the other suggesting an imminent correction. Either way, fast forward now, we are entering the risk zone of the FSC short-term timing model based on certain harmonics on this chart. That is the one to watch for now, because that will change from day to day, week to week, depending on market behavior. But the one that remains fixed in terms of the pattern and the timing is the long-term weekly, suggesting a major top here and now, and likely downside risk into the first half of this year. Now, we have to carry on watching the short-term cycles to see how that plays out. But nevertheless, there is a major top in place according to the cycle model. Now, what's interesting is if we look at diversified external data, chart on the far right here, based on sentiment data using solar cycles, based on sun impacting mood, when this data is high and peaks, typically there's euphoria, and when it's down and hitting an extreme low, there's pessimism in the market. And when did sunspot data peak? Summer last year, 2024. The trough, I might add, is into 2030, 2031. And I will allude to solar activity at the very back end of this presentation when we look at space weather cycles, which is something I look at where possible, as do some of our team peers as well. But we have a non-correlated external data set using sentiment based on macro influences of the sun that we see from day to day, also peaking out summer last year and suggesting a top is in place too. You would have seen some Cycle TV footage from both myself and team colleague Lars von Dienen on this sentiment data. I believe also Lars has actually uploaded it onto the FSC model, so you can even map out cycle data on external macro data too. And thank you there from Paul. Inverse or solar activity plays well for natural gas. And also, if you go back 100 years, solar data was used very much as part of a influential driver on manufacturing and economic activity. Look at the work of Dewey. He did actually write about it, as well as British economist William Jevons and Russian scientist Chizevsky. We've also covered some of those individuals in past videos too. On this slide, the 41-month cycle signals a peak into 2025, although there are variation views as to whether that is leading or lagging right now, and whether that will also be influenced by other cycles. But either way, do keep that in mind. This is a screenshot of the opening chapter of our newly republished Cycles book by Edward Dewey. And you can see here the past cycles developed by Dewey from 1868 to 1957, then updated by the team. And you can see here the most updated version is the chart below, which marked the peak in 2007 and the GFC that followed, and then more specifically, a potential peak right now in 2025 with downside in the following year or so. So that's something to keep in the back of the mind. Do try and plot it on the FSC model to get a more real-time tracking of it. Now, what about the decennial pattern? This has clearly been a top story, and certainly hotly debated for good reason, just because it's important to know what that means for markets. Does this mean year 5 is typically a positive sweet spot or not? Typically it is, but not always. And that's the main point I'm going to highlight here. And if you want more insights on that, both Jake Bernstein and myself have done a full video on the decennial pattern with different perspectives, but still worth watching. The main thing I would recommend with the decennial pattern is to go to the source and research one of the original writers of this pattern, which is published in a book called Tides in the Affairs of Men by Edgar Lawrence Smith. You'll hear many of us citing the primary source authors of these cycles, if they're known, just so we can, make sure that we're connected to that original thinking and research. What's often missed and I think forgotten, partly because so much time has passed, this book was published a long time ago, 1939, is the cause, effect, and timing method research of this pattern. So Smith's theory resulted from combining two other theories, Wesley Mitchell's 40-month cycle theory and the theory of seasonality. It was not just one pattern standalone. Do also note that it's a 40-month cycle variation too. Now, more importantly than that, there was a variation that was spotted in the timing. Combining these two periods, Smith theorized that there would be a 10-year or 120-month cycle. This would result from 10 12-month annual cycles and 3 40-month cycles coinciding every 10 years. So it was a series of cycles that he was watching that chimed in on a decade basis, and therefore the decennial pattern. But there were variations. It wasn't a fixed pattern according to his work. And his own research, he then hypothesized that occasionally a 9-year or 11-year cycle overlaid the decennial cycle. This is such an important point that I highlighted it in yellow so you can see it bright on your screens, but also I did the same on my side in research notes, because I then realized, static cycles work when they do, but they're very good for, statistical backtesting and of course looking for consensus versus outlier. And having that body of evidence as a research note. But there are times where we need to take care, particularly if the original research is open-minded on other influences and effects. Now, the decennial cycle, if you test it across 100 years, does prove out an asymmetric shape with underperformance at the start and end of the decade, and ultimately a sweet spot in the mid part, year 5. Variations do occur, especially if external sentiment data is used, and mainstream industry studies such as, it sees this mostly as a fixed pattern, but often marked by occasional outliers. I'm going to show you what that looks like. This is a chart I did years ago and for internal research for a macro fund that I was working for with mentor Robin Griffiths. And back then, 2015, 10 years to the year, the cycle was flat to underperform. Now, it does happen. It's not the end of the world if there's an outlier, but it did intensify my own research into the plausible influence of nonlinear timing and natural cycles, but also the decennial itself. You can see here the outliers. Best performing was 1915. Worst performing was 2015. My fortune of the time. And the consensus is, you can see there the blue line, 10-year average, the consensus is positive. But keep in mind some of the reasoning behind this. I believe Mr. McLennan, who's part of the FTSE Master Working Group, shared an insight that manufacturing data is partly a macro influencer to the decennial pattern. So in strong economic activity seasons, the decennial pattern year 5 tends to be positive. You also heard my colleague Andy Bencholi talk about context. In a very strong market that is overstretched like an elastic band, the gravity takes effect, and the inclination is for a snapback regardless of a potential cycle influence for that year. And then also keep in mind the other point that was made, cycles within cycles. It depends on your cycle framework. If you're looking at multiple cycles and one is positive, the other one's negative, or there's a lead or a lag, then you have to also factor that in. And again, remember to watch back the video on decennial patterns by my colleague Jake Bernstein and myself. Just getting a message from Mr. Patel. Do we have a month for the peak of the nominal 41-month cycle? Yes. So according to some analysis of our team, it's literally been the last few months, I think into Q4, but we're still tracking that to see how that plays out. Of course, you can get cycle skew, and we still need price to confirm to the downside. Hopefully that answers your question. You can map it out on the cycle model. And that's probably the best guidance I can share. Okay, cycle convergence to close in the allocated time. This is probably the most important big picture macro perspective that I want to share. And I'm really charged up and partly inspired and excited, but also a little bit scared. The one time I hope some of these views get proven out wrong. And you'll be able to learn a little bit more about industry peer views in Cycle TV with interviews with David Murren and Simon Hunt. They're building up some strong record views for good reason, thematic and timing insights, but also all alluding to cycle convergence. So it's something which I hope proves interesting to everyone. And I welcome any questions or insights on this point. So just as a recap, the methodology that I followed for 20 plus years, based upon teachings from my mentor, Robin Griffiths, is an adapted cycle schema from the work of Joseph Schumpeter. And Joseph Schumpeter basically studied the work of prior cycle pioneers, including Kondratiev, Jugular, and Kitchen. We added the seasonal cycle as a short-term variance, which applies cross-asset, but notably US equity markets. What matters most, and a top-of-mind question, is how prepared we are when there's a cycle convergence with some of these patterns, as they likely are now. I'm going to shift away from the methodology that I've used for years, based upon the method of other cycle practitioners, and focus on one of the cycles that are underpinned by it, the debt cycle, which is an important part of Ray Dalio's model of Bridgewater House, which features big cycle of money, credit, debt, and economic activity. And for those of you that want to look up more detail on it, just look up his book, Changing World Order, or the debt cycle research. It operates in 6 stages. And in the latter stages of debt burden, hits a reckoning inflection point that either through restructuring, debt restructuring, or accelerated inflation marks a disruptive moment. This normally follows a period of internal, external turmoil, such as wars, revolutions. On a big picture scale, it marks the peak and decline of an empire. So, and there have been prior empires to the one depicted here. This is based on US, but of course, we've had a British Empire before and other empires too. Look at the interview with Mr. David Murren. He covers this in great depth. But what's interesting here is you can see here where it's highlighted, we are here, debt bust and economic downturn, print money and credit, and then you can see the disruptive nature of all of this once we actually get to that moment of reckoning. Now, this creates a poison chalice effect that will likely make the hopes that President Trump will reinvigorate the US and global economies difficult to achieve. According to the work of Simon Hunt in the interview available on Cycle TV, he believes that at best, there could be a 2-year period of faster growth, but accompanied by rising inflation, which chimes in with this empire model. Keep in mind, it's also a depiction of a transition from unipolar to multipolar as well. And there's lots of useful data as to how this pattern has played out in history too. What this also means is a likely rotation in commodities as part of a commodity super cycle, outperforming equities as this ongoing restrictive monetary condition continues and financial assets and consequential secular inflation forces maintain. This is a chart ratio looking at how things can swing, and ultimately we're starting to see this in some commodity sectors, but still many more to follow in the near term. Now, one cycle to watch as part of the commodity trend is the contractive wave. And you heard my team colleague, Bill Cerruti, but also I believe Andy spoke about it too, and maybe others. Also, interviewees on Cycle TV feature it too. The contractive wave is typically 50 or so years, but on a higher harmonic, 100 plus. And when you map it out on CPI data, typically highlights inflation spikes, but also social and geopolitical disruption. The latest window is from this year for future years ahead. And it's also highlighted by the work of others, such as Ray Dalio, Strauss-Howe, in terms of fourth turning, and the interviews that I highlighted from David Murren and Simon Hunt. So do watch that. It's not Armageddon, worst case scenario here and now, but clearly it's telling us what we already know in terms of when you look out your window and you watch the headline news, and just be aware of some of those risks now in the present. And the closing chart I want to highlight is weather cycle alert, something we can talk about maybe at the cycle conference ahead. It's called the Gleisberg Centennial Cycle. And when we talk about potential weather changes, but also drought effect and 1930s Dust Bowl, this is the one to look at. I'm going to close here just so we can play time catch up and close with our fireside chat, which is yet to come. So just as a recap, latest insights, S&P 500 bull trap reversal, and cycle convergence. Watch back the video for more insights, and please feel free to ping me with questions on email or on social.